Let me ask you something that's going to sound dramatic, but I need you to really think about it. What if everything you've been told about protecting your wealth is about to become obsolete? Not in 10 years, not in 5 years, right now, in the next few months. Because something is happening in the global financial system that most people aren't paying attention to. And the people who are paying attention, they're moving their money into one asset faster than at any point in modern history. I'm talking about gold. Now, I know what you're thinking. Gold? Really? That's the big revelation? But here's what you need to understand. This isn't about gold being a good investment. This isn't about diversification or hedging or any of that traditional financial advisor talk. This is about a fundamental shift in how the world's largest economies are positioning themselves for what's coming next. And when I show you what's actually happening behind the scenes, you're going to understand why this might be the most important financial decision you make in your lifetime. Let me start with something that should terrify you. The United States government is now spending over $10 billion every single week just to service the interest on the national debt. Not paying down the debt, not funding programs, just the interest payments. That's over $1 billion a day going straight to bondholders. Think about that for a second. $1 billion a day, and that number is accelerating. By next year, interest costs will eclipse 3.2% of the entire GDP. That's higher than it's ever been, including during the peak of the 1991 recession. Here's why that matters. When a government reaches this level of debt servicing, they have exactly 3 options. They can raise taxes dramatically, they can cut spending dramatically, or they can print more money and inflate their way out of the problem. Now, which one do you think they're going to choose? Because history has shown us, over and over again, that governments always choose option 3. Always. And when they do, the value of your cash savings, your bonds, your fixed income investments, all of it gets quietly eroded away, but there's something else happening that makes this situation even more critical. And this is where it gets really interesting. BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus their expanding list of partner countries, now control approximately 50% of global gold production. 50%. And here's the kicker. They're also responsible for more than half of all central bank gold purchases over the past 3 years. Let me put that in perspective. Central banks globally have been buying more than 1,000 tons of gold every single year from 2022 through 2024. That's the longest sustained buying streak in modern history. And it's not random. It's coordinated. These countries are systematically reducing their holdings of U.S. Treasury bonds and converting those dollars into physical gold. In October alone, BRICS nations cut their U.S. Treasury holdings by $28.8 billion. That's in 1 month. Now, why would they do that? Why would central banks, the most conservative financial institutions on the planet, suddenly start dumping U.S. debt and hoarding gold? Because they see what's coming. They understand that the dollar's role as the world's reserve currency is under threat. Not from some new digital currency, not from some BRICS alternative that may or may not materialize, but from simple mathematics. When you're printing money to pay interest on money you've already printed, you're in a death spiral. And the smart money knows it. Let me tell you a story that illustrates exactly what I'm talking about. In 1971, President Nixon closed the gold window. That meant foreign governments could no longer exchange their dollars for gold at a fixed rate. It was supposed to be temporary. It's been over 50 years. What happened next? Gold went from $35 an ounce to $850 an ounce by 1980. That's a 2,300% increase in less than a decade. People who held gold during that period didn't just preserve their wealth. They multiplied it by 24 times while everyone else watched their purchasing power evaporate. But here's what most people don't know about that period. The warning signs were there years before the price exploded. Central banks were accumulating. The debt-to-GDP ratio was climbing. Interest rates were rising. Sound familiar? The difference is, back then, the U.S. was still a creditor nation. We had manufacturing. We had a trade surplus. Today, we're the world's largest debtor nation, with a trade deficit that's measured in the hundreds of billions annually. So if gold went up 2,300% when our fiscal situation was actually manageable, what do you think happens now? Now, let me show you what's happening in the actual gold market right now, because this is where it gets technical. But stay with me, because this is important. Gold recently broke through a key resistance level at $2,664 per ounce. That was a 3-week high. The next major psychological barrier is $2,700. On the downside, there's support at $2,592, which is the 100-day simple moving average. Why does this matter? Because in technical analysis, when an asset breaks through resistance levels with strong volume, it typically continues moving in that direction. And gold has been consolidating at these levels, building energy for the next move. But here's what's really interesting. The commercial traders, the big institutions that actually move markets, have been reducing their short positions. That means they're betting on higher prices. And these aren't retail investors gambling on price movements. These are the people who have access to information and analysis that you and I will never see. They're positioning for something big. Let me give you another piece of the puzzle. The COMEX, that's the major commodities exchange where gold futures are traded, has been seeing some unusual activity. The ratio of paper gold to physical gold has been expanding. That means there are more claims on physical gold than there is actual gold available to deliver. Now, normally this isn't a problem because most futures contracts are settled in cash, not physical delivery. But what happens if a significant number of contract holders suddenly demand physical delivery? What happens if, say, a major central bank or a sovereign wealth fund decides they want the actual metal instead of a paper promise? You get what's called a squeeze. And in a squeeze, the price doesn't just go up, it explodes. This has happened before. In 2008, during the financial crisis, there were periods where you literally could not buy physical gold at anywhere near the spot price. Dealers were sold out. Premiums were 20, 30, sometimes 40% above the paper price. People who owned physical gold could name their price, and we're starting to see early signs of that same dynamic building again. Premiums on physical gold coins and bars have been creeping up. Delivery times are extending. Dealers are reporting supply constraints. Now, here's where this connects to your personal situation. If you're sitting on retirement savings, if you have money in a 401k or an IRA, you need to understand something critical. Those accounts are denominated in dollars. And if the dollar loses purchasing power, which is exactly what happens when governments print money to service debt, your retirement savings lose purchasing power right along with it. You might have $1 million in your account. But if that $1 million only buys what $500,000 buys today, you don't have $1 million. You have half that. This is why people are looking at gold IRAs. And I'm going to take a quick aside here because this is relevant. If you have $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. It's worth checking out if this applies to your situation. But let me get back to why this matters right now. The reason this is so urgent is because we're at an inflection point. The technical setup is there. The fundamental drivers are there. The institutional positioning is there, and most importantly, the geopolitical shift is accelerating. Let me explain what I mean by that. For decades, the petrodollar system has been the foundation of dollar dominance. Oil-producing countries sell oil in dollars, and then they recycle those dollars back into U.S. Treasury bonds. This creates constant demand for dollars and for U.S. debt. But that system is breaking down. Saudi Arabia is now accepting yuan for oil sales to China. Russia is settling energy trades in rubles and yuan. The UAE is exploring alternatives. Even traditional U.S. allies are diversifying away from dollar dependence. This isn't speculation. This is happening right now. And when the petrodollar system weakens, the demand for dollars weakens. And when demand for dollars weakens, the value of dollars weakens. Now, combine that with the debt situation I mentioned earlier. You've got falling demand for dollars. At the same time, you've got increasing supply of dollars, because the government has to keep printing to service the debt. That's basic economics. Increasing supply plus decreasing demand equals falling price. And what's the traditional hedge against a falling currency? Gold. But here's what makes this different from previous cycles. In the past, when people talked about gold as a hedge, they were talking about individual investors protecting their personal wealth. Today, we're talking about entire nations, entire central banks, entire sovereign wealth funds making the same calculation. This isn't retail investors buying gold coins. This is institutions with trillions of dollars under management systematically shifting their asset allocation toward gold. And when institutions move, they move size. They move hundreds of tons at a time. Let me give you a specific example. China's central bank has been reporting gold purchases every single month. Now, there's debate about whether they're reporting their full purchases, but even the official numbers show consistent accumulation, and China isn't alone. India, Turkey, Poland, Singapore, the list goes on. These central banks are doing this for a reason. They're preparing for a world where the dollar is no longer the undisputed reserve currency. They're preparing for a multipolar financial system. And in that system, gold becomes the neutral reserve asset that everyone trusts. Because here's the thing about gold. It has no counterparty risk. If you own physical gold, you don't need to trust a government, a bank, or a corporation. The gold itself is the asset. It's not a promise to pay. It's not a claim on someone else's balance sheet. It's real, tangible wealth that's been recognized as valuable for 5,000 years. And in a world where trust in institutions is declining, where debt levels are unsustainable, where currencies are being debased, that matters more than ever. Now let me address something that skeptics always bring up. They say gold doesn't produce income. It doesn't pay dividends. It just sits there. And that's true. But that's also missing the point. Gold isn't supposed to make you rich. Gold is supposed to keep you from becoming poor. It's insurance. It's the asset you hold so that when everything else is falling apart, you still have purchasing power. Think about it this way. If you had bought gold in 2000 at $280 an ounce, and you held it until today at around $2,650 an ounce, you would have multiplied your money by almost 10 times. But more importantly, you would have preserved your purchasing power through two major financial crises, multiple rounds of quantitative easing, and the highest inflation in 40 years. Meanwhile, if you had held cash, you would have lost more than half your purchasing power just to inflation. If you had held bonds, you would have gotten crushed in the recent rate hiking cycle. Even stocks, which have done well, have been incredibly volatile and are currently trading at valuations that historically precede major corrections. Gold has quietly outperformed almost everything over the past 25 years, and it's done it with less volatility and less risk than virtually any other asset class. But here's what I want you to understand. The past performance, as impressive as it is, might be nothing compared to what's coming. Because we've never been in a situation quite like this before. We've never had global debt at these levels. We've never had central banks this coordinated in their gold buying. We've never had the reserve currency status of the dollar under this much pressure from this many different directions simultaneously. And we've never had the technical setup in the gold market looking this constructive at the same time all these fundamental factors are aligning. Let me walk you through what the charts are telling us. Gold has been in a consolidation pattern for the past few weeks, trading in a range between roughly $2,590 and $2,665. This is what technicians call a bull flag. It's a pause in an uptrend that typically precedes another leg higher. The volume profile shows strong support at current levels. The moving averages are all pointing up. The momentum indicators are resetting from overbought conditions, which means there's room for another move higher without the market being stretched. And here's the key. Every time gold has pulled back to test support recently, buyers have stepped in aggressively. That tells you there's real demand at these levels. There are institutions waiting to buy any dip. Now, what are the upside targets? The next major resistance is at $2,700, which is a psychological level. If we break through that with conviction, the next target is $2,800. And if we get through $2,800, there's not much resistance until we get to $3,000. I know that sounds aggressive. But remember, gold went from $1,800 to $2,650 in less than 2 years. A move from $2,650 to $3,000 is only about 13%. In the context of what's happening in the global financial system, that's not just possible, it's probable. But let's talk about the downside risk because that's important too. The key support level is at $2,592, which is the 100-day moving average. If we break below that, the next support is at $2,500. But here's the thing. Even if we do pull back to those levels, it would just be a better buying opportunity. Because the fundamental case for gold isn't based on short-term price action. It's based on long-term structural trends that aren't going away. The debt isn't going away. The money printing isn't going away. The geopolitical tensions aren't going away. And the central bank buying isn't going away. So whether gold is at $2,650 or $2,500 or $2,700, the long-term trajectory is the same. Higher. Now let me tell you about something that happened in 2011 that's really relevant to today. Gold hit an all-time high of $1,920 per ounce in September of that year. Everyone thought it was going to $3,000, maybe $5,000, and then it crashed. It spent the next 4 years in a brutal bear market, eventually bottoming around $1,050 in late 2015. People who bought at the top lost half their money. And for years, gold was considered a terrible investment. The mainstream financial media mocked gold bugs. Analysts said the gold bull market was over. But here's what actually happened. That correction was necessary. Gold had gotten ahead of itself. The market needed to reset. And when it did, it set the stage for the next major move higher. From that 2015 low, gold has more than doubled. And unlike the 2011 peak, which was driven primarily by retail investor fear and speculation, this move is being driven by institutional accumulation and central bank buying. That's a much more sustainable foundation. The 2011 peak was emotional. This move is strategic, and that's why I believe we're in the early stages of a much larger bull market that could last for years. But here's the critical question. When do you get in? Because timing matters. If you buy at the wrong time, you could be underwater for years, like the people who bought in 2011. So let me give you my perspective on this. I think we're at a point where the risk-reward is extremely favorable. Yes, gold could pull back in the short term. Markets don't go straight up. But the probability of gold being significantly higher a year from now, 2 years from now, 5 years from now, is very high based on everything we're seeing. And here's the thing about gold. It's not like a tech stock where you're trying to catch the next big thing before everyone else figures it out. Gold is a mature asset with thousands of years of history. The opportunity isn't about being early. It's about being positioned before the next major leg of the move. And I believe we're right at that inflection point now. Let me give you another historical parallel. In the late 1970s, gold was trading around $200 an ounce. Inflation was running hot. The government was running deficits. People were worried about the dollar. Sound familiar? Gold went from $200 to $850 in less than 2 years. That's a 325% gain. But here's what's interesting. If you look at the chart from that period, there were multiple pullbacks along the way. There were times when it looked like the rally was over. But every time it pulled back, it found support and then made a new high. The people who made life-changing money during that period weren't the ones who perfectly timed the bottom. They were the ones who recognized the fundamental trend and stayed positioned through the volatility. And I think we're in a similar setup today. The fundamentals are even more compelling than they were in the 1970s. The debt is higher, the money printing is more aggressive, the geopolitical tensions are more severe, and the central bank buying is unprecedented. So if gold went up 325% in the 1970s under less extreme conditions, what's possible now? Now, I want to address something important. A lot of people hear this analysis and they think, okay, I'll buy some gold ETFs. I'll get exposure through paper gold. And look, there's nothing wrong with that for trading purposes. But if you're thinking about gold as insurance, as protection against systemic risk, you need to own physical gold. Here's why. An ETF is a claim on gold. It's not actual gold. If there's a financial crisis, if there's a banking system failure, if there's a currency collapse, your ETF shares are just entries in a computer system. They're dependent on the financial infrastructure continuing to function. Physical gold is different. If you own physical gold, you own the actual metal. You can hold it, you can store it, you can sell it. You don't need a functioning banking system. You don't need a functioning stock market. You don't need anything except a willing buyer. And in a real crisis, that distinction matters a lot. This is why central banks are buying physical gold, not gold ETFs. This is why sovereign wealth funds are taking delivery of physical metal, not holding paper claims. They understand that in a worst-case scenario, physical possession is everything. Now, I'm not saying you should bury gold bars in your backyard, but I am saying that a meaningful portion of your gold holdings should be in physical form, stored securely, where you can access it if you need to. And this is where the gold IRA structure becomes really interesting for people with retirement accounts, because you can own physical gold inside a tax-advantaged retirement account. The gold is stored in a secure vault, but it's allocated to you specifically. It's your gold. And if you ever want to take physical possession, you can do that. It gives you the benefits of physical ownership with the tax advantages of a retirement account. And in the current environment, that's a powerful combination. But let me get back to the bigger picture, because there's one more piece of this puzzle that I haven't fully explained yet, and it's probably the most important piece. Everything I've talked about so far, the debt, the money printing, the central bank buying, the technical setup, all of that is important. But there's a deeper trend underlying all of it, and that trend is the loss of confidence in the existing financial system. People don't trust the government to manage the currency responsibly. They don't trust central banks to control inflation. They don't trust the banking system to be stable. And they don't trust the stock market to be fairly valued. This loss of confidence is showing up in all kinds of ways. It's showing up in the rise of cryptocurrencies. It's showing up in the popularity of alternative investments. It's showing up in the distrust of mainstream financial institutions. But most of all, it's showing up in the demand for gold. Because gold is the ultimate vote of no confidence. When you buy gold, you're essentially saying, I don't trust the system to preserve my wealth, so I'm going to preserve it myself with an asset that's been trusted for thousands of years. And when that sentiment becomes widespread, when it moves from the fringes to the mainstream, that's when gold really takes off. Because at that point, it's not just central banks and institutions buying, it's everyone. We saw a glimpse of this in 2020 during the COVID crisis. Gold went from $1,500 to over $2,000 in a matter of months as people panicked about the unprecedented money printing and economic uncertainty. But then the crisis passed, or seemed to pass, and gold pulled back. But the underlying problems didn't go away. They got worse. The debt got bigger. The money printing continued. The structural issues in the financial system deepened. And now we're at a point where those problems can't be ignored anymore. The interest payments on the debt are unsustainable. The inflation is persistent, the geopolitical tensions are escalating, and the central banks are out of tools. This is the environment where gold thrives, not because gold is going up, but because everything else is going down in real terms. And that's the key insight I want you to take away from this. Gold isn't really an investment. It's a form of savings. It's a way to preserve purchasing power over time. And in an environment where currencies are being debased and debt is spiraling out of control, that's exactly what you need. So when I say this is a turning point for your life savings, I'm not being hyperbolic. I genuinely believe we're at a moment where the decisions you make about how to protect your wealth are going to determine your financial future. You can stay in cash and watch inflation erode your purchasing power. You can stay in bonds and watch interest rate risk destroy your principal. You can stay in stocks and hope that valuations don't matter. Or you can allocate a meaningful portion of your wealth to the one asset that's designed to preserve value in exactly this type of environment: gold. Now, I'm not saying you should put everything into gold. That would be foolish. Diversification still matters. But I am saying that if you don't have meaningful gold exposure right now, you're taking a huge risk. Because if I'm right about where this is headed, the opportunity to buy gold at reasonable prices isn't going to last much longer. The central banks know this. The institutions know this. The smart money knows this. And now you know this. The question is, what are you going to do about it? Because here's the reality. Most people will hear this information and do nothing. They'll think about it. They'll say it makes sense. They'll tell themselves they'll look into it later, and then they'll get distracted by life and forget about it. And then 6 months from now, or a year from now, when gold is at $3,000 or $3,500 or $4,000, they'll wish they had acted when they had the chance. Don't be that person. If you have significant retirement savings, if you have wealth that you've spent decades building, if you have a family that depends on your financial security, you owe it to yourself to take this seriously. Look at the evidence. Look at what the central banks are doing. Look at what the institutions are doing. Look at the technical setup. Look at the fundamental drivers. And then make a decision based on logic and reason, not emotion or inertia. Because the turning point is here. The signs are everywhere. And the people who recognize it and act on it are going to be the ones who preserve and grow their wealth through whatever comes next. The people who ignore it are going to be the ones asking what happened to their savings when the dust settles. So take action. Do your research. Understand your options. And position yourself accordingly, because your life savings are too important to leave to chance. And in the current environment, doing nothing is the riskiest move of all.